Some candles are not just bars on a screen, they are warnings. A few special shapes tell you in advance when a trend is about to turn. The candles themselves are the signal. You just have to know which shapes to look for. Today we learn the 5 most important candlestick patterns, the ones professionals watch for every single day. And there is one golden rule we will come back to again and again. A pattern only matters in the right place. The same shape that screams reversal at a key level means nothing in the middle of nowhere. Keep that in mind as we go. Pattern 1 is the doji, and it is all about hesitation. A doji is a candle that opens and closes at almost exactly the same price, so its body shrinks to a tiny sliver, almost a flat line. Look at it, price tried to go up during the day and got pushed back, then tried to go down and got pushed back too. Buyers and sellers fought all day to a perfect draw. Nobody won. On its own, a doji just means indecision. But when one appears after a long, strong trend, that sudden hesitation is your first clue that the side in control is getting tired, and a turn could be coming. Pattern 2 is the hammer, and it is one of the most reliable bullish reversals there is. A hammer has a small body up at the top, and a long lower tail hanging beneath it. Here is the story that tail tells during the day. Sellers shoved price way down. But before the close, buyers came roaring back and lifted it almost all the way up again. That long lower wick is the footprint of buyers violently rejecting the lower prices. When you spot a hammer at the bottom of a downtrend, near support, it is telling you the sellers just got overpowered, and the bounce may be starting. Pattern 3 is the shooting star, and it is simply the hammer flipped upside down. It has a small body down at the bottom, and a long upper tail stretching above it. This time the story is reversed. Buyers pushed price way up during the day, full of greed, but before the close, sellers slammed it all the way back down. That long upper wick is sellers rejecting the higher prices. When a shooting star shows up at the top of a strong uptrend near resistance, it is warning you the buyers just ran out of gas and a drop may be next. Pattern 4 is the bullish engulfing, and it is a 2-candle pattern, a real show of force. First you see a small red candle, the sellers still nudging price down. Then the very next candle is a big green one, so big that its body completely swallows or engulfs the entire red candle before it. In one single day, the buyers did not just win, they overwhelmed the sellers and erased all of yesterday's selling. A bullish engulfing at the bottom of a pullback is one of the clearest signals that control has flipped from sellers to buyers. And pattern 5 is its mirror, the bearish engulfing. First a small green candle, buyers still pushing gently higher. Then a huge red candle whose body completely engulfs that green one, wiping out all the buying in a single session. That is the sellers seizing control in a violent takeover. When a bearish engulfing appears at the top of a rally, near resistance, it is a powerful warning that the trend has flipped from up to down. So there are your 5 shapes: the doji, the hammer, the shooting star, and the 2 engulfing patterns. But remember the golden rule. Context is everything. These patterns are powerful at the edges of a move, at support and resistance after a long trend. Floating in the middle of the chart, they are just noise. Now let us hunt them on 3 real charts. Our first pattern is the doji, and here it is in real life on Wells Fargo, and notice where it appears. That is the whole point of the lesson. Look at the left side of the chart. Price had been sliding one red candle after another, day after day. The sellers were clearly in control and the mood was negative. If you were just following the trend, you would assume the drop keeps going. Now look at this one candle. It opens, and by the closing bell it ends up at almost exactly the same price it started. Its body shrinks to a tiny flat line. That is a doji. And read the wicks. During the day, price tried to push up and got rejected, then tried to push down and got rejected too. After all that fighting, the day ended in a perfect draw. Here is why that matters so much in this spot. For days the sellers had been winning easily. Then suddenly they could not push price any lower. Buyers met them head on and held the line. That sudden hesitation, right at the bottom of a slide, is the doji's warning the side in control is running out of steam. And watch what happened next. The relentless selling stopped, the candle turned green, and price bounced back up over the next couple of days. The doji did not promise a reversal. No single candle ever does. But it flagged the exact moment the downtrend lost its grip. That is the doji's job. It tells you to pay attention, because the balance of power may be shifting. Our second pattern is the hammer, the bullish reversal, and Broadcom gives us a textbook one. This single candle tells a dramatic story, and it is all in the tail. Start with the body. Notice it is small, and it sits right up at the top of the candle. The open and the close are close together, near the high of the day. On its own, a small body is not exciting. But now look below it. There is a long, thin tail stretching way down, all the way to $405, marked by the red line. Here is what that tail is telling you. At some point during the day, sellers were in total control and shoved the price down hard, more than $10 below where it opened. Things looked terrible. But it did not close down there, not even close. Before the bell, buyers came storming back in and bought the entire drop back up, dragging price all the way to the top of the candle again. That long lower tail is the footprint of buyers violently rejecting the lower prices. That is a hammer, and it shows up at the bottom of a pullback, exactly where buyers love to step in. And the payoff came fast. The very next day, price exploded higher and ran all the way up to $440. The hammer marked the precise low. So here is the red, a small body up top, a long tail beneath. Sellers tried, buyers won, and the bounce was on. Our third pattern is the shooting star, the bearish reversal, and it is simply the hammer turned upside down. Microsoft shows us a clean one, and again, the story is all in the tail. Watch this candle. Price rockets up during the day, spiking all the way to $428, marked by the gold line. For a moment, the buyers look fully in charge. It feels like an exciting breakout, the kind of move that pulls people in to buy. But look at where the candle actually closed. It could not hold those highs at all. Sellers stepped in with force and crushed the price all the way back down, leaving just a small body way down low and a long, thin tail pointing up to where price got rejected. That long upper wick is sellers refusing the higher prices. And notice the context: this happened at the top of a push higher, right where eager buyers get trapped chasing the spike. A shooting star up there is not a breakout. It is a warning that the buyers just ran out of gas, and the warning paid off. Over the next few days, price rolled over and fell all the way to $408. The candle that looked so bullish at its high was actually the top. So here is the read: a small body down low, a long tail above. Buyers tried, sellers won, and the drop was coming. Read the wick, respect the context, and a single candle like this can keep you out of a bad buy. Our fourth pattern is the bullish engulfing, a two-candle pattern, and a real show of force. JPMorgan gives us a clear one, and notice it is the first pattern so far that takes two candles to read instead of one. Set the scene on the left. Price had been drifting lower on red candles. The sellers were quietly winning, nudging the stock down day after day. And right here is a small red candle, more of the same. Nothing looks like it is about to change. Then comes the candle that flips everything. The very next day prints a big green candle, and look how large it is. It opens below the prior day's close, and then powers all the way up to close above the prior day's open. Its body completely swallows, engulfs, that little red candle before it. In one single session, the buyers did not just nudge price up, they overwhelmed the sellers and erased the entire previous day. That is the meaning of an engulfing candle, a violent handover of control. And the context makes it count. It came after a pullback lower, exactly where buyers like to step back in and take charge. And from there, buyers held the higher ground, with price working its way up to 313. Real charts are not always a perfect straight line afterward. There is always some back and forth, but the engulfing candle marked the moment control flipped from sellers to buyers. When you see a big green body completely eat the candle before it, pay attention. The crowd just changed its mind. Our fifth and final pattern is the bearish engulfing, the exact mirror of the one we just saw, and the most powerful top reversal of the group. Amazon shows it perfectly, and again, watch where it lands. Set the scene. Price had been grinding higher near its highs, and here on the left is a calm green candle. The buyers look like they are still comfortably in charge. Everything seems fine, and this is exactly the moment a careless trader keeps buying near the top. But look at the very next candle. A big red one opens above the green candle's close, then sells off hard all day and closes below the green candle's open. Its body completely engulfs the green day before it. In a single session, the sellers wiped out all of the buyers' progress and seized control. And think about the psychology, because it is the whole game. Every trader who bought that calm green day is now trapped in a loss the instant that red candle engulfs them. As they panic and rush to sell, their selling piles on top of the sellers already there. That is why a bearish engulfing at the top can fall so fast. It is not just new sellers, it is a stampede of trapped buyers all running for the same exit. And that one red candle marked the turn. Price rolled over and slid down to 266 over the next few days. If you had been reading the candles, the pattern told you the whole story before the drop, and it kept you from buying right at the top. A big red body that swallows the green before it, up at a high, is a serious warning. Let us lock all 5 into one checklist you can run on any chart. 4 shapes, and 1 golden rule. 1. The doji. Open and close in the same spot, a tiny body. It is a standoff, and after a long trend it warns you the move is tiring, just like we saw on Wells Fargo. 2. The hammer. A long lower tail at the bottom of a drop. Buyers rejected the low, so it is a bullish reversal. Broadcom dropped to 405 and rocketed back. 3. The shooting star. A long upper tail at the top of a run. Sellers rejected the highs, so it is a bearish reversal. Microsoft spiked to 428 and fell. 4. Engulfing. A big candle whose body completely swallows the one before it. That is control flipping in a single day. Green over red is bullish like JPMorgan. Red over green is bearish like Amazon. And 5. The most important of all, context is king. A pattern only counts at a real level or after a real trend. The exact same shape floating in the middle of the chart is just noise. Always ask, where is this happening? Doji, hammer, shooting star, engulfing, and always context. Run those checks and these shapes will start whispering the next move to you before it arrives. If this made it click, subscribe. We build a new trading skill from the ground up every week. And that is the language of candlestick patterns, the shapes that warn you in advance when a trend is about to turn. The doji's hesitation, the hammer and shooting star with their long rejecting tails, and the engulfing candle's violent takeover. And above all, the golden rule context is king. Here is your homework. Open any chart and hunt. Find one doji after a trend, one hammer at a support level, one shooting star at resistance, and one engulfing candle at the end of a move. Do that on 10 charts this week, and these 5 patterns will jump off the screen at you for the rest of your trading life. If this gave you a tool you will actually use, subscribe. We build the next skill from the ground up every single week. See you in the next one.